The Middle East conflict is 8 weeks old, and the media is still not optimistic. Cautious headlines are saying it's a buyer's market. Bold ones claiming there is a shock and the market is crashing. And even if the peace deal lands tomorrow, a lot of people are not convinced that the Dubai real estate market will recover. That's why we need to talk about what the data is saying. Will developers survive the fall in demand? And where investors can really get 30 to 50% discounts. And you're not even looking there. Starting with Dubai developers' financial state. And let me show you this chart right away. It shows the number of new off-plan projects launched in Dubai. And you can see that now numbers are really low compared to the pre-war period. 2 to 4 projects per week is a new normal. Compare that to up to 20 projects per week in February. The off-plan market slowed down significantly. And of course it affects developers' revenue. And this situation raises questions about developers' financial health. Are they strong enough financially to sustain such a huge drop in revenues? And right on time, S&P Global published a report that contains financial data on 4 major Dubai developers. S&P rates these developers. They have access to their financial data, and they can publish this data. Developers need them when they attract funds from the open markets, for example, when they issue bonds. So developers that got into this report are Emaar, Damac, Shoba, and Omniyat. And let's look at this chart. It shows the cash balance of these developers. How much money do they have on escrow accounts, in cash, or in liquid investments? Omniyat currently has more than $1 billion. Shoba has almost 2. Damac has 7.7 billion. And Emaar is the largest one. 11.7 billion on escrow accounts and 7.5 billion in cash or liquid investments. That's more than 19 billion in total. Another interesting take is their revenue backlogs. What is a revenue backlog? It's a metric that shows how many years developer has in contracted sales. So the developer sells the property, there is an SPA signed, and there is a certain schedule of payments. And there is money that they haven't received yet, but they are supposed to receive them according to contracts. Let's take Omniyat for example. Their revenue backlog is 5 years, meaning that all the money they will get from their buyers for the units that they already sold will be 5 times larger compared to their annual revenue. So they can stop selling completely and still get 5x their annual revenues from the units they already sold. For Shoba, this ratio is 2 years, for Damac is also around 5, and for Emaar is 2.7. So what do all these things mean for investors? First, the market slowdown doesn't impact their ability to deliver. They will keep building and they have more than enough money to finance that. Number 2, the slowdown in new launches will continue. These developers don't need to launch new projects unless they can charge normal prices. They have no incentives and no need to shrink their margins. They have a lot of cash. They're not cash poor. Number 3, the current situation is very much different compared to the 2008 crisis. Back then, developers were over-leveraged. They didn't have enough cash, and they were financing the construction works from fresh buyers' deposits. Now they have a lot of money on escrow accounts, and they're generally cash-rich. This means no liquidity crisis, no bankruptcies. At least big Dubai developers are in a pretty good financial position. At the same time, buyers are craving discounts, they're craving special offers, but there are not that many of them coming from reputable developers. However, Ellington recently launched a guaranteed returns program. And I am very skeptical about guaranteed returns. We broke these schemes down many times on this channel, and in my opinion, they often don't have any legal substance, they don't have any economical substance, and pretty often they're not the best investments. But Ellington is quite a reputable developer, so we decided to review what they are offering. So the offer is 7% guaranteed rental returns across 6 projects. 4 of them are in Dubai, 2 in Ras Al Khaimah. The duration of the program is 5 years, and the returns are supposed to be paid once in 6 months. Now let's translate 7% guaranteed returns into net yield. For example, we're taking a 1-bed in Mercer House. The price is 2,850,000 dirhams. Based on that, the guaranteed rental return should be 199,000 dirhams per year. But we also need to deduct service charges, so we get roughly 178,000 per year. So the effective net rental yield is around 6%. It's not very high, which is good because it makes this whole program more believable, more economically viable. But if you decide to go for this, you should know several things. First, this guarantee transfers to the next buyer, but it does only once. So the next investor, the one that buys the property from you, will get the same returns, but the next buyer will not be eligible. Second is, Ellington guarantees 7% gross yield, not 6% net one. So if service charges change and get higher over time, it impacts your net yield. And the final point is that Ellington will manage your property, it will rent it out, but you can exit this agreement. There is a 12-month notice, but if you decide that this scheme is not for you, you can exit it. So I'd consider this as an insurance. You secure 7% gross yield, but if the market goes up and you can get higher, you exit the agreement and rent it out yourself. Interestingly, Bengati has also decided to launch their guaranteed returns program. In their case, the claim is 10% guaranteed return, but the structure of this program is completely different compared to what we just discussed. So this offer applies to a specific project, Mercedes-Benz Places. It's not a rental income guarantee. It's kinda like a cashback that you get during construction. Cashback is not the terminology they use, but I think it will make this thing easier to understand. So they provide 10% cashback on the amount you pay throughout the year, and you receive it by the end of the year. So let's say you paid 200,000 dirhams in 2027. Your guaranteed return is 10% of that, 20,000 dirhams. 20% down payment is not taken into account, so effectively you get 8% cashback throughout the construction period. So let's say a studio is priced 1.3 million dirhams. The construction period is 3 years. You don't get guaranteed returns on the 20% down payment you paid, so you get 104,000 dirhams cashback over 3 years of construction. It brings the effective price down to 1,196,000 dirhams. So this is the current situation with the off-plan market. Unfortunately, no huge discounts, not crazy attractive offers, at least not from top developers. But the trend for ready properties is pretty different, so let's discuss them. As we usually do, we start with sales listings. We keep an eye on them because listings show the real market picture before transactions show it. So this chart shows the number of listings across apartments, villas, and offices. And they're pretty stable, in the normal range, which means that there is no mass selling, which is a good indication, and it shows that 7 weeks after the war conflict started, there are no signs of panic selling. The picture is pretty consistent across all areas. On this slide, you can see some of the most popular Dubai areas. In all of them, or almost all of them, the number of listings is pretty normal. Next, let's look at transaction volume. This chart shows the number of weekly sales transactions for ready properties in Dubai. And here the data is pretty consistent. The number of closed deals, the number of sales transactions, has dropped by roughly 50%. And this chart should be analyzed in combination with the chart we saw 30 seconds ago. If the number of listings is at the normal level, it means the number of people who wants to sell hasn't changed. But the number of real transactions has changed and went down by 50%. So there is a gap. And this gap exists because there is a mismatch of expectations. Buyers want discounted properties, but many sellers don't want to give discounts. So fewer transactions are happening, and those sellers who can wait, they will wait. But at some point of time, they will run out of patience, or some external circumstances will force them to sell. And if the demand doesn't go up, sellers will have to reduce the prices. As of now, average prices haven't dropped much. This chart shows the dynamics for different property prices, and if we take apartments for example, then current prices are roughly 5 to 7% lower than during the pre-war period, and they're still higher compared to the beginning of the year. Now let's discuss rental contract data, and here I want to show you two charts. This one shows average rent price per square foot for villas, apartments, and offices. These are new contracts only, and they're the better indicator for the current market situation. Ignore villas trend because it contains both villas and townhouses, and this fluctuation you see on the chart is pretty artificial. But apartment rental prices, they're pretty flat. During some weeks we saw a 5 to 10% decrease compared to the normal period, but there is no massive drop. So what's even more important is new contracts volume. Let's look at the next chart and pay attention to apartments. There was a big drop initially, roughly 50% in the beginning of the conflict. But then the situation stabilized, grew up a bit, and now we're roughly at minus 25% versus normal levels. This is the result of some positive dynamics of the conflict, like ceasefire, but rental contracts are also widely affected by schools. And this week schools in the UAE went back to normal. So many people who temporarily left Dubai, they went back. This is the long-term contracts data, but there are also short-term contracts. Short-term contracts data is hidden for most people. Short-term contracts data don't get into DLD database, but we talked to some Airbnb property managers and got their data. And what we saw, and also what we learned from them, reveals an interesting investment opportunity. So before the conflict, an average property was renting out up to 75% of days. After the war conflict started, occupancy rates dropped significantly. In the middle of the March, actual occupancy was at around 35%, but in April it's higher, roughly at 50% level. That's an improvement, but still much lower compared to the pre-conflict levels. And because of that, landlords offer 30 to 50% discounts on sublease contracts. Those landlords that rent out their properties short-term currently have three options. They can wait for 3, 4, or 5 months until the market recovers, which is quite an uncertain option. They can wait for long-term rentals, but we just saw that the demand dropped significantly. Or they can provide discounts to Airbnb operators. So Airbnb operators who sublease the properties can enter now at a much lower price. And if the positive trend continues and occupancy rates keep increasing, then it can be a good deal. This scheme is definitely not for everyone, and generally during the current market situation, it became much harder to find exceptional investment opportunities. That's why we significantly reduced the number of project overviews on this channel. However, recently, a very high potential investment opportunity became available. Check out this video to learn more.